Now, 2020 was a very tough year as the uncertainty of the pandemic emerged. Equity markets around the world fell precipitously and then staged an amazing turnaround in the second half of the year. Now, one of the asset classes that surprised us all again last year was the fixed income sector. And as the securities there continue to provide resilience and an area for investment returns. So with that in mind, we're going to move on to our first speaker, Rashaad Tayob. He's the portfolio manager of the Flexible Income Fund and a member of the 15-strong investment team at ABAX Investments. In 2020, the Flexible Income Fund once again beat its objective of outperforming the STEFI 110% of the STEFI composite, returning 5.7% versus the 4.95% cash equivalent benchmark. I'd like to hand over to Rashaad Tayob to provide some detail on how this was achieved and lay out ABAX's current thinking on the sector. Rashaad will illustrate some of the importance of maintaining the course irrespective of the environment surrounding us and how this feeds through to the consequential portfolio structure. And on that note, Rashaad, I'm going to hand on to you now to take us through the slides. Thank you.
Morning, everybody. Thanks, Rob. It's good to be able to make the time to give everyone an update and an outlook for what's going to be an interesting year as we navigate ourselves out of this pandemic. I'll start off by just giving a summary of what happened in 2020. In terms of the mix of different asset classes that we have in the portfolio. The Rand, ended the year about 5% weaker against the dollar, but compared to its worst, where it depreciated from 14 to above 19 to the dollar, so that was close to a 40% depreciation at its worst. The recovery was quite phenomenal. I think if you look at the roller coaster that the Rand has taken us in the last 2 or 3 decades, which we had another one in 2020. Cash delivered 4.5% as the repo rate was cut significantly by the SARB in order to boost the economy. Inflation linkers delivered 4.2 as they re-rated yields moved higher, which had a negative impact. And then they recovered towards the end of the year. And the All Bond Index ended the year with an 8.7% return, which seemingly a very standard type of year, but that masks the very big drawdown that materialized in March and April, where you had around a 15% drawdown for the month, and over 20% in its worst periods. The poorest performing sector was the property index with a 40% drawdown, and that followed on from a poor year in 2019. So we've had a big drawdown in terms of the local property sector, and then preference shares, given the issues in the economy and the banking sector, they were down about 11%. Now, how that contributed in terms of the total return, the portfolio had about a 6.4% gross return. And if you look at the strategy in terms of having a diversified alpha approach, trying to get returns from a mix of different asset classes and diversifying across the fixed income space, that was a function of offshore returns, SA cash, floating rate notes. Our linkers had quite a nice contribution because we had a low exposure to inflation linkers going into it, and then we bought aggressively into the weakness, taking the exposure from about 4% up to 15%. Bonds also had a nice contribution to return. We did have a bit of a drawdown in March, but we bought into that weakness, and that helped in order to deliver us quite a nice return. The detractors were property and preference shares. Property, we've been quite cautious, in terms of our property exposure. And we went into this with under 2% exposure, but just given the extent of that drawdown, it was our biggest contributor, even though it was a relatively small exposure in the portfolio. And then preference shares, we had about 3% to 3.5% exposure, but it also felt quite significantly, and that's why it was one of the detractors. But overall, I think the portfolio did its job in terms of delivering a cash plus return and diversifying risk across a range of the different fixed income asset classes. Now, going into 2021, it is quite a conundrum because the repo rate has been cut from around the 7% level. We're now sitting at a 3.5% repo rate, and JIBAR is sitting at 3.6%. So in terms of the core portfolio, where we've always had JIBAR linked floating rate notes delivering you anywhere from 100 to 200 basis points, those are now delivering you returns with JIBAR 3.6%. Those are now delivering returns of 4.6 to 5.6%. So yes, we've got a low level of credit risk. This is a stable component of the portfolio, but the return has shifted fundamentally lower given that rates have been cut aggressively. Now, you still can go into the bond market and you can get a 9% odd return on the 10-year bond. And if you look at that gap, it's very wide by historical standards. But what we caution against is that the risk is materially higher compared to a decade ago when we were sitting with about a 40% debt to GDP ratio. We're now at 80% debt to GDP ratio. So your risk on that bond component is fundamentally higher. So where we add bond exposure, we look to do that within a risk control framework by adding linkers, by looking for hedges, by having an increased FX exposure as we incrementally increase the bond. So yes, we do think there's an attractive component to bonds, but it's not a situation where you can just close your eyes and pile into bonds because the risks are materially higher because of our debt position. You can see that how our debt levels have increased dramatically. For example, since 2012, from about the 40% level, we are above 75%, and we are heading higher. And there's a gap that's opening up between ourselves and our emerging market peers. If you look at the countries, the two countries which have piled on the most amount of debt in this crisis in 2020, it's firstly the United States, which is obviously the biggest economy in the world, and the dollar is the global reserve currency, but following closely behind is South Africa. So the two of us have been outliers in terms of putting on massive amounts of debt in 2020. And both of us are suffering the consequences. And the reality of putting on large amounts of debt is that you've got to issue a lot of bonds, and someone needs to buy these bonds. I've got this data from Nedbank whereby they look at the rolling 12-month issuance of bonds, and you can see since 2012 we issued between anywhere 150 billion rand of bonds per annum, and those are bought up by pension funds, unit trusts, the PIC, etc. And then our debt crisis started to emerge even before COVID. So last year, the budget, we were set to deliver an 8.5% deficit, and that was without any pandemic. So we had begun to increase our debt, our bonds, our bond issuance from about the 150 up to the 250 level, even before COVID had materialized. At the moment, we're at a phenomenal run rate of 450 billion rand per annum of bond issuance. And it's difficult to see how the market can continue to absorb this issuance. So yes, pension funds have increased their exposure. Unit trusts like the ones we manage have looked at these 9% yields and said, okay, we need to have some exposure there. So across the spectrum, you have this increased amount of take-up of these bonds. The SARB has chipped in by buying bonds as well. But it's beginning to crowd out the investment industry in South Africa because 450, 500 billion rand per annum is a phenomenal amount. It's very difficult for the local savings industry to continue to absorb that amount of bond exposure. So the question is, who's going to buy these? And the answer in the rest of the world is that the central banks of the world have basically bought up the bond. So in South Africa, that's not the case to date. We had the SARB, they had about 8 billion rands of SAGBs, South African government bonds, on their balance sheet. And through the crisis of April, May, June, they brought that up, close to the 40 billion level. And then since that, the volatility and the crisis abated, they've not added to that. So they've allowed the market to determine the fair value of the bond yields. And that's why we've got a very steep yield curve. And we've got, 10-year yields at 9% and 20-year yields close closer to the 10.5% level. So, and the back end of the curve, the 30-year yield closer to the 11% level. So we've got one of the steepest curves out there. And the question is, how sustainable is this? Is it sustainable for the government to be funding at yields of 9 to 10% when you've got an 80% debt to GDP ratio? The numbers just don't add up. So we've got two options. Either we have some fiscal restraint where the Treasury delivers credible budgets and much lower budget deficits, or the SARB is going to be forced to bring those bond yields down through intervention. But if they do that, you're going to see the rand a lot weaker. So the question of what's going to happen, that will be answered over the course of the year. Inflation-linked bonds, this is an area where we've seen a lot of value. We had very low exposure, from the 2014, 2013 period onwards. In fact, between 2013 and 2018, we had zero exposure because we felt real yields were just too low. They weren't reflecting the adequate risk premium for South Africa. We had about 4% exposure going into the crisis, and then last year when yields were close to and above 4%, we added about 10% to the portfolio. So we took the exposure from about 4% up to 15%. Yields have come down and recovered back to about 3% level, but we do think on average they present quite an attractive return from a risk-return perspective. So going into 2021, as we recover from this crisis, but we potentially go into a debt crisis because we're sitting now with the legacy of poor fiscal management of the country, fiscal mismanagement, which was apparent in 2018, accelerated in 2019, where we were delivering an 8.5% budget deficit pre-COVID, and then blew out the budget in 2020 with about a almost 16-17% deficit. This is what we're facing going into 2021, and our strategy is to continue to focus on diversification and downside risk management. Have a diverse portfolio of fixed income assets in order to generate a cash plus return without introducing a high level of downside risk. Yes, you can get a good yield by going into SAGBs and getting 9-10% returns, but you are taking a fundamentally higher downside risk by doing that. We've got a large component of floating rate notes. We've got fixed rate bonds at around 15%. We've got inflation-linked bonds at around, close to 16% now. We like inflation-linked bonds as well as convertible bonds. We've added to that, consistently. We've got a component of preference shares, and then offshore bonds and offshore money market about 18%. And we've managed that hedge on an active basis. Through that property weakness, we have ticked up our SA property exposure from about the 1.5% to 2.5% level. Yes, there are headwinds, but it's a real asset and it is delivering returns. But we are still conservative. We're not up at the 4 and 5% in terms of property because of the risks that are apparent. And then a component of money market, which gives us that optionality in order to be able to buy into weaker assets in the case of in potential sell-off. And going into the budget next month, I think we are going to be a little bit on the cautious side. So overall, a 12-month projected yield of just over 6% with a low level of downside risk, a duration of 1.5, but that's spread out. So a component of that 0.65 from SA nominal bonds, 0.5 from inflation linkers, 0.35 from offshore bonds. And then our offshore net FX exposure, that's around 8.5%. We've increased that substantially as the rand dipped below 16 and then below 15. We've taken off some of those hedges that we had put in place at the higher levels, and we've allowed that FX exposure to move up from the 4% up to the 8.5% level. And we think it's a very nice hedge in terms of risk of the portfolio, especially where the rand is at the moment and in terms of the portfolio structure. So that's the way we structured, and we'll continue to focus on that diversification, minimizing downside risk, and maintaining high degree of credit quality for the portfolio in order to deliver those cash plus returns. Thank you. I'll hand back to you, Rob.
Thank you very much, Rashaad. That was very comprehensive. I'm just going to start by asking you a question on there's the sort of thing that fund managers hate to do is to give us some predictions on or expectations. And can you just touch on what your expectations for the inflation rate going through this year, and then perhaps consequentially what that might mean for any interest rate movements? Obviously, we have the inflation outcome this week and also the meeting of the SARB. So what are your expectations for this week and also for the year ahead?
Yeah, so I mean, inflation with the rand strengthening quite substantially will continue to be muted, and we see it at around the 4 to 4.5% level for 2021. I think it's going to be it's a far more uncertain outcome than historically. So, for example, there's about 4 or 5 economists in the local market we track closely, and we had a chat to them earlier this week. And we got their forecast for 2021, and they range from 3.9 all the way to 5.2. So if you look at that range of outcomes compared to historically, usually, they'll be expecting 4.5, some will be 4.7, some will be 4.3. But what we've got at the moment is quite a bit of uncertainty in terms of the potential outcomes for inflation. But in terms of our expectations, we closer to the midpoint, around 4.5%. And yes, there is a chance that the SARB utilizes this rand strength in order to throw in, a rate cut on Thursday, because we do have a SARB meeting. But the rand was here at the last MPC meeting. We think they're in a holding pattern. So we've seen a lot of split decisions over the last 3 meetings, whereby it was a 3-2 decision either way. But at the last meeting, they were more confident in terms of holding, and we think they've cut very aggressively down to 3.5. And on balance, they're likely to remain on hold unless something significant changes. And going into the budget, in next month, I think they are likely to, maintain a conservative approach and say, let's just leave it on hold for now. And if we do need to provide further stimulus and the market and inflation allows that, we could do that towards the middle of the year, but let's remain conservative for now. So on balance, I think they're likely to remain on hold on Thursday.
Thank you, Rashaad. And one final question. I think we've got a couple of minutes left with you. Can you just give us what your expectations for the portfolio as a whole, given everything you've told us today in terms of, one, will it be able to achieve its benchmark outperformance again, as you have continuously done? Thank you for that. For this year ahead, and what might that number look like in terms of absolute return?
So the strategy for the fund has always been about diversified alpha and looking at a broad range of strategies in order to generate a cash plus return and protect downside risk. Now, things have it was a dramatic year in 2020, and given the fiscal risks in South Africa, which we've highlighted for a number of years, there's always a risk that's going to come to a head in 2021-22. So what does that mean for our strategy? In fact, it just means that the emphasis on diversified alpha and downside protection is even more emphasized. So if you look at the mix of different asset classes, the core portfolio is set to deliver around 5% return. Now, that's our base, and it is lower than what it has been historically because rates have been cut aggressively. But that is a core component. It's low credit risk. We can rely on that component. And then we look at the components of offshore, of SA bonds and inflation linkers to deliver that additional return of cash plus 1, maybe up to 2 and 3% in good years that we've been able to deliver. And if you look at the yield on the fund, it's over 6%. So yes, we are set up to deliver a return of around 6%, which is around the cash plus 2 level. And anything additional will really depend on what happens in terms of the market. If the rand blows out, that will allow our offshore component to deliver additional returns, but it might negatively impact our bond component. If we have a situation where we have a risk-off event and bond yields kick up, there will be a negative component to that because we do have some fixed rate bond exposure, but we are hedged. And maybe that will allow us to buy into bonds when the yields are much higher. And if we do then see a recovery, depending on the path of how that happens, you could see an additional return. But overall, it's about having diversification, having that cash plus return. The total return, if we had to fast forward to the end of 21 will really depend on how this, pattern in terms of risk, in terms of the rand, and in terms of how the bond market performs and what opportunities it gives us over the course of the year. But we're very much aware of the benchmark and what our job is in terms of delivering cash plus with a lower level of downside risk.
Rashaad, that's fantastic. Thank you very much for your time today and joining us on the webinar.
Thank you.